Well, good morning, everyone. My name is Nick Callil from Willis Towers Watson. I'm delighted to welcome you to this concurrent session of the All-Actuaries Summit. With me today is Brnic Van Wyk of QSuper, and today's session is about the QSuper lifetime pension. We have an hour for discussion of this really exciting topic. Brnic will be leading us through the background to this product for about 40 minutes, and then we've got lots of time for questions, which you can enter in the chat room on your screen. So again, welcome. I'm really excited about this topic because, as many of you who work in this area will know, lifetime income streams in retirement has been something there's been a lot of talk about, but not much action on among the big players in the superannuation industry for a long time. And so to see this product come on stream, I think is a really important development, and hopefully kicks off a round of innovation and action from the funds in this industry in this really important area. So great to have everyone along. Really excited about this topic, and I'll be engaging with Brnic at the end of his session on a number of questions that I'm interested in, and as I say, really interested in lots of audience questions and chat on the chat room alongside your screen. So let's go. Brnic, I'm going to hand over to you. Lead us through the development of this product, and to our audience, please enter your questions and we'll engage those with Brnic afterwards. Thanks, Brnic.
Thank you very much, Nick, and good morning, everybody. And thank you to the Actuaries Institute for the opportunity to share what we also believe is quite an exciting development. So, my name is Brnic. I work for QSuper. I'm the head of asset liability management in the investments team. And what I present to you today is a new lifetime income retirement product that QSuper launched on the 1st of March this year. Now, at the outset, what the hell? It's very important to note that this is not a Brnic game. This is there's very much a large number of people that contributed all the way from our board, our senior management, my peers and colleagues and staff at QSuper, a dedicated and significant project and change management team, my personal team that built a lot of the models. We sought some input globally from thought leaders, but I do want to call out two sort of people specifically. One is the UBC, the University of British Columbia in Canada. This product is very much a bit of a copy of what they've done, a very successful product they've been running for more than 50 years, the VPLA. And then we can go into that a little bit later in the question time if you want. And then finally, my friend and colleague, Ben Hillier, he's the head of product and services at QSuper. And without him, this would not have been possible. And I think vice versa. So Ben and I complemented each other quite well, maybe let's say from a qualitative and quantitative approach, and you'll see that shines through as I go through the presentation. So what do we really aim to do here? It's pretty simple. We want to give our retirees the confidence to spend higher rates of income. That is how simple it is. I'm not going to belabor the challenges we have in this industry though. So the lifetime pension is, and throughout this presentation, please remember this slide. It is not a product to beat or contrast or be better than an account-based pension, or be better than an annuity, or be better than a GSA or a deferred annuity, or any of those kind of things. And we can use those known products as to sort of contrast the features, but that is not what we've set out to do here. What we've created is a complement to the existing retirement sources that retirees have. So at the moment, there's the age pension and the income account, at QSuper, the account-based pension. And this lifetime pension is built to complement those income sources. And you'll see as we go through the different purposes that people use it for. Now, in that way, it allowed us to contrast the features of what members are used to at the moment. At the moment, the only real option at retirement is that of what we call a QSuper, our retirement income account, our drawdown account. And our PDS documentation does not specify the lifetime pension in isolation. So there's a retirement PDS, which then puts the choice to retirees as to how much to allocate to a retirement income account and how much to allocate to the lifetime pension. And it allows the communication and the engagement to contrast the various features, from access to capital, investment choice, guaranteed lifetime income, regular payments, higher payments, and so forth. And I'll go through these key product features of the lifetime pension now in detail. Firstly, and this is how we present this to members, the product pays income for life, right? So there are fortnightly payments. You can't vary the payment frequency due to the sort of arbitrage opportunity there. And also for our systems, right? We had to keep it as simple as possible. So when somebody purchases one of these contracts, their income is paid fortnightly. The second very key important feature we communicate to members is that it pays higher levels of income. The majority of our drawdown accounts are drawn at the minimum rate, and these commencement rates from this product is up to 50% higher than a standard account-based pension drawn at the minimums. We achieve that by investing the assets in the QSuper balanced option. And that means we make an annual adjustment to pensions in payment. And I'll detail that much more a little bit later. But that annual adjustment effectively ensures that the pool remains solvent. And the adjustment is based predominantly on the investment returns earned in the year. But because we invest in balanced, we create a higher expected income over the long term, which allows us to pay higher expected levels of income. There are potential age benefits. So this product falls within the category of an innovative income stream as specified in the Act and the regulations. So it doesn't have to comply with minimum drawdown rates. It is not a traditional annuity, but these new innovative income streams, as regulated by the government, has a concessional age pension treatment and means tested treatment. So there's the opportunity for some members to get an immediate uplift on age pension benefits. There's an option to take out spouse's protection. That just means in our language, you can have a joint life annuity. The income continues at 100%. There's no reduction in income on the death of the first in the couple. And the reason for that is pretty much practical, because in reality, for most Australian retirees receiving part age pension, in the event that one passes away, the assets of the household pass to the remaining person, which then gets assessed as an individual for Centrelink purposes and age pension purposes, with significant, potentially quite a bit more in assets. And generally, you find the age pension actually reducing on death of a partner. So we didn't want to reduce these benefits as well. And again, it just kept it simple. People could understand the pension continues for the last survivor. We have a generous cooling off period, and this probably starts talking to some of the annuity puzzle biases. There's a 6-month cooling off period during which people could terminate or surrender the pension. Thereafter, it's permanent. On cooling off, the benefit is a return of nominal capital, less income payments made, and that is subject to a market value test. So in other words, if there's been a significant market downturn, we can only pay out the amount of assets we actually hold in the pool, thereby protecting other pool participants from any sort of arbitrage or people pulling out when the markets have crashed. So the nominal return of capital in that cooling off is only during markets that are not negative. And then finally, we introduced a money back protection benefit. So this basically says you always get your money back. And that money back protection is in nominal terms, the return of nominal capital less income payments made. So the way it's presented to members is if you get less than your original purchase amount as income, the balance would be paid to your beneficiaries or estate upon your death. This is the only insured component of the product, and I'll go through that as well in some detail. But without this, it would just be unsaleable. Right? So it's not potentially the most efficient feature, but definitely one that's required by members. So the initial starting income rates, these are contained in our PDS documentation. What you see in the heading there is, unfortunately for some, the only actuarial formula I have in this presentation. It is a very simple, immediate lifetime annuity. It is calculated at a rate of 5%, a net 5% rate, and uses quite a light mortality table. So what we've done is we used the latest ALT 1517 population mortality. We included all the mortality improvements, and we then favored a higher proportion of the female rate, which was also again lighter, just to get a light mortality table. That is then used at a simple nominal 5% interest rate to calculate these effective starting rates. Now, these are amounts per 100,000 invested, and you can see as they compare to the right-hand column, the minimum drawdown amounts, the age-based minimum drawdowns in the normal account-based pension, quite a bit higher. When people join, they get the exact rate of income on the day they join, based on their exact age on that day. So that avoids the sort of unnecessary behavior where people would wait until their next birthday to get more income. These rates are enduring, so we don't intend changing them for a number of years. They're not like traditional life insurance annuities that get quoted every week, and they're gender neutral. So again, the gender neutrality to create simplicity there. Throughout, you will hear the word simplicity a lot. We've made a big effort to ensure the people who actually need to buy these products understand what it is. So, and the last thing we wanted to do is, we know that on average females retire with less money. We know statistically they've got higher life expectancies. The last thing we wanted to do is to tell our females, well, you save less than your male counterparts, and we're going to give you less income in retirement. So there is a bit of a positive bias towards females in these rates. And then for the couples rate, it really very simply takes the age of the youngest couple. It's restricted to starting between ages 60 and 80, and that ensures that people have reached a condition of release and can remain in the tax-free environment. So how do we keep them enduring, and what do we do? As I said, there's annual adjustments to income, and this effectively ensures that the pool remains solvent. So you can see there, I'm suggesting as this example, a 60-year-old, we go back to the previous table, a 60-year-old couple with $100,000 buys $5,770 annual income. That translates to a regular fortnightly payment of $220. Imagine the financial performance of the pool was 7% in the first year. That is 2 above that benchmark of 5% we use in our annuity. And very broadly, that allows us to grant a 2% increase in that year. That increase is not on the starting rates we showed, that is on pensions in payment, and pro rata for those that joined during the year. So if you look at the second year, imagine the performance is 10%, awesome, 5% against the benchmark, above the benchmark, so a 5% positive adjustment to pensions in payment. A minus 2% return in the balanced option gives us 7% below the benchmark, and pensions will be reduced. And so on and so forth. When the benchmark is 5%, there are no adjustments to pensions. So this is the investment experience predominantly. There are minor adjustments for expected for mortality experience. And the reason, again, is, as I explained, the 2 assumptions we use in creating those starting rates is a mortality and a net return assumption. The mortality assumption is specifically set what we would say broadly realistic. So in other words, very light, hopefully as close as possible to the actual experience in the pool, so that adjustments to pensions as a result of mortality deviation is expected to be minor and small. That allows us to then publish our balanced option returns are published daily. The unit prices are declared daily. So these are transparent completely. There's no actuarial black box. Members can see what the returns are. And as the year progresses, they can get a good indication of broadly the adjustments they can expect. So a 5% investment return parameter, we would argue, is on the slightly conservative or slightly more prudent side as a long-term expected return out of a diversified balanced option. So you'd expect to get returns in excess of that, which gives you an expectation of broadly positive adjustments over time on average to annual pensions in payment. There's no sort of targeted inflation or anything, but it does create an expectation of positive returns. And we'd expect the investment experience to dominate and far exceed adjustments as a result of mortality experience. I'll show you some of the sensitivity analysis we did on that towards the end. Now, what does this create? It creates an income stream that is volatile, and we're not hiding from that. So here we have a simple sort of back test. It is 300,000 invested in 1998 by a single 60-year-old retiree. And you can see during the GFC, during COVID, at times there are reductions in pension. Over time, broadly increasing. And over this sort of 22-year period, a total of 564,000 paid as income. Now you compare that to what would have been paid from a $300,000 account-based pension drawn at the minimum. And there are a couple of observations here that I want to draw out. The first one is the starting income from the lifetime pension is significantly and noticeably higher. On the graph, maybe it doesn't look like it, but it's close to $20,000 a year compared to roughly about 12, 13. The second observation is that the volatility of the income is broadly similar. You can see they both go up and down at the same time. So members are already used to income volatility from their account-based pensions, and this continues with that. It doesn't hide away or try and protect against investment risk, but it does provide the lifetime income. The other observation, you will see that the account-based pension, due to the minimums, the age-based minimums increasing over time, you get increasing income at advanced ages when arguably that income would be better used in earlier in life. And then finally, there's the reduced minimums. And what we've seen is almost 75% of QSuper retirees that were drawing the minimum took the reduced minimum during the GFC and during COVID. And this, we would argue, is an intolerable level of income volatility. So the next item I want to mention is the money back protection. Remember, we said this is the only insured component. This is if somebody had to pass away prior to receiving all their original capital as income. Again, a simple stylized example. Imagine $100,000 invested. Over time, the cumulative income payments received by this individual shown in the graph there. And the simple answer is the money back protection is the gap between the original capital and cumulative income payments. So that is a decreasing sum insured. We have an in-house insurance company, but it really is plain vanilla life insurance. There's no underwriting, there's no anti-selection here, and the insurance premium rates are surprisingly affordable. And the reason for that is that these are calculated at the individual level, but paid by the pool. So there's a couple of factors that sort of impact on this. One is we'd expect most people buying this product to be in couples. Most people retire as couples, and the couples insurance rate to insure a sum of money in the event that both people pass away in the next year, the probability of that is quite low. So the premium rates are actually quite low. At more advanced ages, where there are more single retirees and where one of the couple has already passed away, these rates are quite expensive. But by that stage, you are paying it out of reserves, fund reserves, at a fund level in respect of a sum insured that has already decreased dramatically. So there are some offsetting factors. The other thing as well is, imagine the experience is pretty poor and our insurance premiums had to increase dramatically. We would see a counter effect in the mortality credits, because if you get more than your expected deaths, there would be mortality adjustments on the other side. And then I can answer some more questions around that if there are. The next part of the presentation I want to touch on is a huge amount of work we had to do that was completely non-technical. We had to build calculators. We had to build advice modules, advisor training. We had to build new calculators. Here we have our bespoke retirement projection calculator, and broadly you can see it is roughly the same as what most funds or providers have. A couple of unique items. You see the slider at the bottom, where these are on our public website. You can go and play with them. You can allocate different amounts or different percentages to the account-based pension versus the lifetime pension. The landing page of this calculator, you'll see there's an 87 years life expectancy there. So the landing page creates an income goal that draws down the account-based pension at life expectancy plus 5 years, with 50% allocated to the lifetime pension. So there's a bit of an anchor bias in the calculator, no nudge or recommendation or default, but the landing page does end up at 50%. Towards the left, you can also see that we can draw out money that can be accessed, flexibility, in other words, capital access to account-based pension. In the first 6 months, there's the cooling off period, but then the capital allocated to the lifetime pension it becomes permanent. And in this example, you can see there's a difference between the money that can be accessed flexibly immediately and those that will be payable upon the death of the participant. We also made a second calculator, and we call this our year one calculator. And what we did here is we want to show people the immediate uplift in income by paying the lifetime pension. Because if I go back, most people in our testing sort of dismiss this picture, this long-term, what happens when I'm 100. People are concerned with the here and now. And the lifetime pension makes a big difference here and now. So the year one calculator, again, very simple assumptions. It is on our public website. Shows 30%, 50%, and 70% allocated to the lifetime pension. It shows your total income from drawing the minimum and in the account-based pension and the lifetime pension. And then it has a very rough estimate of a potential age pension uplift, predominantly based on the account-based pension or the total superannuation savings, and assumptions about being in the taper zone. So there's a slider there in the middle, you'll see at 50%. Again, it's the landing page. You can slide it all the way to 0 and all the way up to 100%. But again, we're trying to use this as a little bit of an anchor bias to say you have to consider putting some money in there, but you don't have to at all. Then some more practicalities. Here is an infographic that I pulled off our intranet. And the only thing I want to say here is it was a non-trivial undertaking to get this done. the technical design, which is why I named my colleague Ben at the start. The technicalities and the design is probably the simple part. Getting it built and launched and operationalized and regulatory approvals, that was a big undertaking. And to me, that's a little bit of a warning for the industry more broadly. And I wonder how many funds really would have the capacity to actually do this themselves. Now, I did promise I'll show some sensitivity analysis. And we are quite outspoken about this 5% benchmark that people can transparently observe. But we know that there's going to be a difference between what the returns are that are earned in the pool compared to the published balanced option returns. And some of it, yes, is as a result of mortality. But at the outset, when the pool scale is still small, there's a very real chance that the money-weighted return, or the IRR in the pool, differs noticeably from the time-weighted return in the markets. And that is a combination of potential volatile markets combined with cash flows. So over time, when you get to a point where there are a large number of participants in the pool and the relative weight of new cash flows, new entrants, new purchases is small, this difference diminishes. But at the outset, there is what I would call an engagement or a member communication risk, in that the expectation may not be met due to cash flows. And here's some of our stochastics that we ran through our investment platform. You will see in the first year, it doesn't matter how many people join, throughout the year, the cash flows could create quite big differences, very big differences between what the balanced option time-weighted return is and what the actual money-weighted return in the fund is. However, after quite some time, you see here we went out to year 10, you see this range reduces quite comfortably, and it's no longer a problem. We also showed this to the board visually. So here is the scatter plot, and you can see just very broadly, just visually, it deviates from that diagonal quite a bit over time. And at year 10, the difference between time-weighted and money-weighted return narrows much more comfortably. So the investment experience will dominate, but the investment experience could also be slightly unpredictable. The mortality experience, this one a little bit more interesting. Our modeling shows it should start stabilizing at roughly about 500 lives. And this is not inconsistent with what we've seen from other sort of products around the world that pool mortality. 500, interestingly, I mentioned UBC at the start. As I said, they've been running their variable payment life annuity for almost 50 years now. And their lives, it's only available to their faculty in the faculty pension plan. They've got about 430 lives in there on average over time. And it's actually running pretty okay. So that's not inconsistent with what we've seen in our modeling. The one thing that was interesting, though, is that this mortality effect is potentially skewed to the right. So early on, again, when the pool is small, the volatility of experience could be quite dramatic. And with investments, it was up or down. But with mortality, the severity of this skewness is effectively inversely related to the pool size. So the smaller the pool, the worse the potential volatility is. But that volatility, interestingly, is positive. So because we've got such a light mortality assumption, effectively, in a very small pool, if nobody dies, we make small negative adjustments of 1% or less to pensions in payment. But imagine there's only 10 people in the pool, which thankfully we've passed now, and they're all sort of roughly the same, and one of them had to pass away. The nature of this operation means that you have to allocate the full mortality credit to the remaining participants. So investment volatility, mortality volatility, if it occurs, would be effectively positive for people in the pool, for those survivors in the pool. And then here, a couple of things that I already sort of mentioned. Starting this is not easy, right? I mean, we've all learned, we've all went to university, and we've all done our models. And I found that it's all based on this beautifully stable, eloquently distributed, standardized population distribution. But when you start something like this, you only have one person in there, and over time you build up. And if you look at our pool, we're restricting entrance to ages 60 to 80. It will take quite some time for that pool to reflect what is effectively a population distribution over the full age range. So that creates potential anomalies in the experience that wouldn't necessarily emerge as part of the modeling. And I think this is even more extreme if you had to consider deferred type annuities, where that experience is effectively leveraged. So getting to scale quickly is quite important to start seeing some smoothing in the mortality experience, limit that funny potential investment experience. And what we've done there is targeted our existing retiree base. So QSuper has approximately 55,000 existing retirees in the income account and the account-based pension. And that has been the area where we've spent most of our attention. It allows us to get a little bit of spread across the age ranges. And it also allows us to get existing retirees in much quicker than what you would with what is generally positioned as a retirement product, where future retirees on a sort of a drip basis would start joining. We didn't have to seed any investment pool by using our existing balanced option, which is at the moment probably $25 to $30 billion, well diversified across a variety of asset classes, probably the lowest volatility balanced option in Australia. It has got a history, it's quite transparent, it is reviewed by the ratings agencies, and an added bonus for us at QSuper in this case was that QSuper unit prices are struck net of all fees, all taxes, investment fees, taxes, as well as administration fees. So QSuper administration fees are expressed as 16 basis points, percentage of assets, which means that for this product, we didn't have to make any expense or add additional administration charges or anything. It is effectively already taken care of through the balanced investment option. And then this was another one, probably also linked to new entrants to the market. The nature of this product means there's no shareholder capital or solvency capital required. There's no reserving, there's no smoothing policies, there's no actuarial black box or judgment or subjectivity in adjustments or rates or income. And that means that the financial risk to the organization is effectively non-existent, other than obviously the cost and the payback to develop it and the ongoing operational cost. But other than that, there's no capital required. Maybe a technicality, the insurance company underwriting an insured death benefit, yes, that's a different requirement. But we could have used effectively any insurance company. For strategic reasons, we used the internal QSuper company or wholly owned QSuper insurance company. Another item Ben and I talk about quite a bit is trust. We are not dismissing how important that is. QSuper members trust the scheme. It's got more than 100-year history. Yes, it does have a state government history as well, the expectation that things will be taken care of. And this probably contrasts with, let's imagine a large international European-based insurance company launching a new product in the Australian market. And I can imagine it's hard for mom and pop in Rockhampton, who've been teachers their whole lives, to part with their hard-earned, or part of their hard-earned capital, to an unknown, albeit well-established international company, as opposed to the superannuation fund that they've always known and trusted. And then transparency, finally. I mentioned that a couple of times, transparency of the methodology, of the income rates. So at the outset, the two principles that Ben and I gave the project teams was compelling and simplicity. And I hope you've seen that through some of these designs. So who is it designed for? This, I think this is a general, if I could say, a very broad general agreement in the industry, not just in the actuarial profession, but more broadly. In the Australian context, people with very little money have longevity protection in the age pension. Those with lots of money don't need these kind of products, and it's those in the middle that are the problem. Now, it's early days, but what we've seen so far in the experience and what people are doing and who is buying this product, personally, I've been proven wrong on every single one of these. And I'll show you quickly what we've seen so far. As I said, we only launched on the 1st of March. And since then, the average amount that people use to buy a lifetime pension, just over $200,000, but that ranges from as little as $33,000 to more than $500,000. And there are actually a number of them more than $500,000. So the average hides the wide dispersion there. The minimum is $10,000. Probably not for the discussion here, but it's just we had to pick a minimum, and it's $10,000. Of those people that have bought pension, their total superannuation balances was just over 500,000, but it's ranged from as low as a total of 100,000 to literally in excess of $1.5 million. So again, a very wide range. That's very hard to make any sort of definitive conclusions. The average balance of allocated to or the average of superannuation savings that we can know of that's allocated to the product, about 47%. And you might say, well, that's no surprise given where the calculators land at 50%. But I saw a histogram of this last week. There's only one person that picked 50. The rest are just dispersed over a very wide range, from as low as 10% to literally all of their money. In fact, that lady that had only had $102,000, she was the one that put in 50%. Now, the age range, again, I probably personally would have expected less people at the advanced ages, but again, it literally spans the whole range. We almost have every single age represented from 60 to 80 across the people that have bought it so far. Another surprising factor that we're still learning is less than half of those new pensions were spouses ones. So we also always say that people retire as couples, but more than half of these pensions that have been purchased are single options. And from what we can see and ascertain is those people are single. They do not have current spouses. So if you cover all of that across the spectrum, the effective payout rate is about 7%, and that's probably something you can contrast with average payout rates and APRA data and so on. So there's no secret sauce here, right? The higher income is created by helping people spend their capital. And then finally, the first 50-odd applications have been predominantly self-directed. These individuals were not advised. They attended our seminars. They worked through our education material. They used the calculators. And We would expect advised people to come through in coming months, and I think that's just logistics as people have to make appointments with advisors, and those are normally like 3-4 weeks into the future, and then SOAs to be issued, and so some of these statistics could possibly change over time, but this is what we've seen in the early days. So who's it really designed for? And Ben actually went and called the first dozen or so people and asked them, and we've had people with low balances, very keen to lock in income for life, not being reliant on others. You could also argue, I don't think it's self-directed, but you could say elder abuse could be avoided this way. These are obviously fake names, but this is what people said, right? The age pension benefits, interestingly, haven't come through as a big reason, although the very first person who bought one of these products was in the sweet spot, absolutely in the sweet spot. And but as far as the rest of our members go, the main reasons they have enunciated why was peace of mind. There were people where couples bought the pension where one of the couple only had about $250,000, put the whole 100% in, and the other person in the couple bought, say, 400,000 pension from about $1.5 million. So if we view them as a couple, you could say they put roughly a third of their overall wealth in. And even in those couples, there were some of them where the husband and wife had different reasons for buying it. A wife one of the partners saying that they don't want to be burdened with large financial decisions at advanced ages when their partner passes away. They want to lock it in now. And there was even one person that one of their reasons was they want to make sure their money stays with QSuper. Sorry, that's not a reason why we would suggest. But the almost confronting part for me was that people use this for their own needs, and it is not necessarily economical needs. Most of the reasons they enunciate are behavioral. So on that note, I'll conclude with, again, another internal picture. This is what we show our staff. What are the benefits? And maybe here I'll say, I hope you've heard throughout the sort of 40-odd minutes that I've been speaking, we do not use the word longevity. We do not use the word annuity. We do not use the word tontine or GSA or any of those technical terms. What we say to our members and in our documentation is we provide higher levels of income and the confidence for you to spend that. So on that, Nick, I'll pass back to you and try and get out of this. There we go. And take some questions.
Thanks, Brnic. That was great. And to our live audience, please fire away with your questions. We've got a few coming through. And I will mention now, after the end of this session, there's another half an hour chat in the video chat room. So please sign up for that if you want to take a deeper dive into some of this, some of the questions we're talking about with myself and Brnic. Brnic, just can I first of all take you back to the sort of concept stage, the design stage? You mentioned you went around the world, you tapped into thought leaders around the world, you looked at other products and obviously ended up with something pretty close to the University of British Columbia product. In that stage, I mean, one of the key decisions, I guess, would have been, do you look for a sort of an immediate income stream type product or a deferred product? Because a lot of the examples we've seen and some funds have pushed ahead with this in terms of how you develop these products is to think of it as we'll break it into sort of the first 20 years and then a deferred product that kicks in later with a longevity component. Why didn't you go down that path? Why did you do this as an immediate product?
Probably the simplest way to answer that, Nick, is the way Ben does it. He says, well, imagine you're trying to sell this to somebody, and what you say to them is, please give me some of your capital, and if you then die when I expect you to, we will give you nothing. The fact that people dismiss longevity risk, right? So I think we as a profession and as let's say actuarial professionals, we get caught up in the systemic longevity risk issue, and we're worried about putting that on balance sheets. Individuals do not believe they've got longevity risk. And one of the other things that I've learned here is there's actually a difference between the fear of running out of money and longevity risk. So what our product does in technical terms is it effectively pools individual idiosyncratic longevity risk. So every retiree has the uncertainty of their own life expectancy. And I would suggest almost 95% of the people that have bought this so far have expressed that in some way, shape, or form. They don't know when they're going to die. They want to make sure their money lasts. They are not saying, I'm worried that I turn out to be 100. So, and I think that's one of the things where as an industry, we struggle because we're caught up in that sort of systemic risk. Now, if that systemic risk materializes in this product, it'll be gradual over very long periods of time. Right? It doesn't eat capital. It will be experienced by the participants in the pool. But at the outset, every individual gets immediate sort of comfort around their own uncertainty.
Yeah. So I'll try and get in as many of the audience questions as I can. Just sticking on the sort of design themes before we look at some of the more detailed question. David Knox's comment, a focus on income but less focus on access to capital. Is that important in your thinking? So how did you balance those two, that how much protection of capital or access to capital you gave?
The primary sort of feature of the product is higher income with less risk. And the risk there is risk of running out. So the capital protection was never a feature of the product, but without it, it wouldn't sell. So it's almost, and that almost the same as the longevity, right? So at the outset, we want to give people confidence to spend higher amounts of money. Even the traditional sort of, if I can call it the financial planning plan, where you plan to run out at life expectancy, people actually won't spend that. Nobody will spend half their money that's remaining 2 years away from their life expectancy and then spend the last amount of money the year that they're turning 87. They just won't. So in order to provide the confidence to spend this capital early, you have to solve for longevity, which is embedded in the product. Sorry, I got a little carried away. The question was, the capital access is probably earlier. If you can't say you always get your money back, it's just one of those behavioral components you have to include.
Thanks. A few other questions. Ruby's question is on the rate of return that you need to achieve a steady level of income. Do insurance premiums and admin fees affect that, or is it just a 5% flat?
It is a 5% net. So if I can answer it, it is 5% net, net of investment fees, net of administration fees, net of any taxes, potential taxes in the investment, withholding taxes and stuff. Although it is in the retirement phase, the international assets sometimes attract something. And then it's net of insurance costs. So we do have a provision in that 5% for an estimate of insurance costs.
Okay, thanks. Patricia Berry's question is one that's, I think, interesting. Just looking more at the governance aspect of this, and I think a lot of funds I've seen have sort of struggled with this. This is clearly a complex beast. It's not a quick process to develop this. How do you sort of drag your board and the various committees and other layers of governance in your fund along with you. Clearly, you can't arrive at the end of the process and say, "This is what we've spent the last 12 months thinking about. Can you approve it, please?" So, how did you manage that?
It was it was an entertaining 18 months of my life, Nick. Probably mention the regulatory process. There's the government established the 4-agency cross-agency process, so we engaged with that across the ATO, APRA, ASIC, and DSS. And I would imagine because we were the first fund testing some of those new regulations, that was challenging. But to their credit, every single one of the government agencies were very encouraging and very proactive, and within the constraints that they have, very encouraging. So that was hard, but it was a positive process. The board, we did engage over long periods of time on a piecemeal basis. We had product features initially. We had a very strong governance framework that we had them approved, and we also sought external validation. So often your fiduciaries are seeking, or they say, "Oh, you Safar, come and tell me how this works. I want to know from the experts as well." So yes, you mentioned we had a couple of international study tours that provides some external validation. We had a professional sort of actuarial firm validate the methodology at the outset, and then we had another major independent consulting firm right at the end. So the very last sort of formal board approval day, Ben and I actually didn't get to say much. The discussion was led by an independent party. So the board was seeking very definite, and make no mistake, it was a tough decision for them, right? I mean, at one stage, one of them said, "Well, if this is so great, why is nobody else doing it?" And you almost want to bite your tongue and say it's because people ask questions like that. So they were our board is very well aware that what they've started here is something that will go well beyond their lifetimes, and they took it very, very seriously. And then I'll just conclude by saying everybody's aware of our discussions. We indirectly had to go through 2 boards because we're in sort of a final merger discussions. So yeah, that was a non-trivial exercise. But very constructive from all the participants, just risk averse and careful.
I'll just mention again, because we may not get to all the questions, but please join us in the chat room afterwards, and we can probably dig particularly into some of the more technical questions. Michelle has asked, are retirees worried about the lack of protection from inflation? So yeah, one obvious design feature that you see in some products, but not in this one, is an inflation-protected income stream. Has that raised any concerns?
Short answer, no. It's just not a factor. Maybe, and this is my personal view, maybe it is something not as bad as longevity risk, but similarly a risk that emerges over long periods of time. Non-financial people make decisions very much on the here and now, and inflation doesn't burn them. The product in seminars and stuff where we could engage more directly with members, if you explain to people that there are positive adjustments over time, in a country like Australia where inflation outlook is reasonably benign or manageable, if there's some kind of positive adjustment, it's accepted. And then again, I'll take you back to the 3 little balls I showed right at the start. There is more than inflation protection in the age pension part of a person's income, as well as potentially sort of CPI plus returns in the account-based pension component. So with this product in isolation, maybe see it maybe put it alongside consumption patterns. So if you imagine sort of higher consumption earlier in retirement, you don't need inflation adjustment on your whole income stream right up until at very advanced ages.
Yeah, agree. If I can put Robert Cole's just recent question up there, perhaps I would just digest that one. I'll just ask maybe a related question, just more on the more technical point. You mentioned, I think, that you used population mortality for as your baseline. Now, the adjustments are much more weighted to investment return than mortality experience, as you pointed out. But notwithstanding that, I mean, that mortality experience, did you look at using lighter mortality based on the fact that presumably there's some selection with people who choose this product?
Oh, the mortality is very light. So yes, the baseline is population, Australian population mortality. I mean, it doesn't matter whether it's a formal publicized table, as long as it's a light one you're broadly comfortable with, because the experience in the pool will be relative to that assumption. We're not underwriting that mortality, whether it's females or males or sick people or healthy people. So yes, the baseline is a standard population table that we have adjusted to create a light table. We didn't think it would have been any more useful to use UK annuitant mortality or anything. But I see Robert's question here as well about competitive or initial income rates. I mean, let me comment on that. The UBC model, as I said, UBC has been running for 50 years. Initially, their investment assumption, if I can call it that, was 8%. And then what they found is over time, the number of negative adjustments was probably not ideal. So they reduced it to 7%. And then, which was something that they felt, which was a level they felt broadly targets nominal income. And they also introduced a 4% option, which was an option that doesn't guarantee inflation, but provides sort of an expectation of a real income stream. So they've got two options. People can choose from a 7 or a 4. And what they've told us is that most retirees would put half in each. So they put half their money in the one and half their money in the other one.
So we've got time for just probably one more. There are a few. Again, I apologise to those whose questions I won't get to. Just again, and there's another question here on the scale, and you talked about the 500 lives. There's a couple of questions. Anthony Ash has asked one, and Robert Cole different angles to that. I mean, is the 500 lives robust? Anthony's question whether there's bigger volatility than what you'd be comfortable with at that level. You're comfortable with the 500 lives, and if I could add to that, apart from the mortality aspect, what about sort of legacy product issues, or if you like, scale at a business level for this product? Is there a critical mass that you need to get to for it to be sustainable?
Yeah, so the scale applies in two areas. One is for member experience. So the pool can run with 2 people in it, right? But the volatility of that experience is going to be dramatic. So you want to, the 500 number is a sort of let's call it a base minimum where we feel comfortable that the experience sort of broadly starts stabilizing and there's enough capital to limit some of the investment volatility. And it's at that level that UBC have been running sustainably for more than 50 years, right? And those 500 lives are spread across the whole spectrum, proportionally from 60 to 110. So yes, it's not perfect and it doesn't look like our models, but it's at least reasonable. That level probably also covers the scale from an operational perspective. So you need to get the admin fees, right? So QSuper can't run a product with 2 people in it. So there are certain business targets. And then a legacy product, our sort of internal and board discussed exit strategy revolves around the fact that the pool is always solvent. So every year, every 1 July, when you make adjustments, you set the pool back to 100% solvent. You effectively have the actuarial equivalent for every participant. You remove that way something I perhaps haven't mentioned, the intergenerational cross subsidies between individuals. But if at any point we'd have to pull the plug, we can seek alternative arrangements for all the participants with 100% funded actuarial equivalent of the benefits from the pool for them at that point in time. And whether that takes the form of buying other annuities at rack rates or moving it back into an income account or ABP, it remains. We're not planning to do that, but the capital will be there at the time.
Thanks, Brnic. We are out of time. We could talk for a lot longer, and as I mentioned, jump into the video chat room now if you're interested, and we will keep talking for another half an hour. But for now, to our audience, thank you very much for joining this session, and enjoy the rest of the summit.